In Manhattan Beach, one group of sellers just saw the median price drop nearly 20% in a single month, while another group is currently getting offers at 108% of their asking price. If you just read the headlines, you'd think the luxury market is collapsing while the entry-level market is overheating. But if you sell into that assumption going into 2026, you are misreading the data. The headline numbers for December 2025 look like a complete contradiction. You have single-family homes showing a double-digit price decline on paper, yet condos are seeing bidding wars reminiscent of 2021. If you are planning to sell in the next 6 to 12 months, misinterpreting these signals could cost you a serious 5-figure check or leave you sitting on the market while your neighbors cash out. This isn't just about market conditions. It's about a fundamental split in how Manhattan Beach is trading right now. Walking through the tree section or the sand section today, you feel the tension. On the quiet residential streets, inventory is tighter than it's been all year. But glance over at Sepulveda or Rosecrans and you see the future looming. State mandated density and 7-story proposals that are about to change the value map of the city forever. We're looking at a market defined by extreme scarcity. In the single family sector, we have just 2.15 months of supply. In the condo market, it's even tighter, down to 1.32 months. In plain English, that means that if no new homes came on the market, everything currently for sale would be sold out in about 8 weeks. A balanced market usually has 4 to 6 months of supply. We are nowhere near that. We are in deep seller's territory, but it's a tricky, uneven landscape where leverage depends entirely on exactly what you own. Homeowners across Manhattan Beach are using my equity snapshot to quietly benchmark the position before they ever talk to an agent. It's a privately monthly digest that keeps you dialed into your equity and local trends right from your inbox. You can start tracking today using the link in the description below. I'm Hernandez, your real estate advisor here in Manhattan Beach. My job isn't to sell you a house today. My job is to help you build a flight plan for your equity. Most people look at the citywide median price and think that's what their home is doing. That is a dangerous shortcut. Your home lives in a very specific lane, whether that's a legacy estate in the hill section or a townhome near the water. And those lanes are moving at different speeds. In this update, I'm going to show you exactly where the speed is, why the price drop you're seeing in the headlines might be a mirage, and how new zoning laws along Sepulveda could impact your sale in 2026. Let's start with the most aggressive lane in the market right now, the condo and townhome sector. If you own a condo or a townhome in Manhattan Beach, the data for November and December is flashing red hot. The sell to list price ratio for this segment just hit 108%. Said simply, on average, buyers are paying 8% above the asking price to secure the unit. We haven't seen a number that high since the ultra low rate era. And here is the kicker. The median sold price for this segment jumped over 83% month over month to $2,875,000. Now pause for a second. Did your condo actually increase in value by 80% in 30 days? No, that would be impossible. What this number tells us is that the mix of what sold changed drastically. We saw premium, likely ocean view or high-end townhome inventory transact, pulling the median way up. But the signal that matters for you is that 108% ratio. What that really means for you is that if you decide to sell, you have immense leverage. With only 6 active listings in the entire city for this category, buyers have zero optionality. They are desperate for a foothold in Manhattan Beach and they are willing to stretch. You can push your pricing strategy provided your unit is turnkey. If you're buying a condo or a townhome right now, you need to understand that the list price is just the starting gun. You are not negotiating a discount. You are competing for a scarce resource. If you aren't writing an offer that is clean, fast, and likely over ask, you aren't even in the room. Now let's look at the single family residence market, because this is where the data gets confusing and where the risk of drawing the wrong conclusions is highest. In November, the median sold price for a single family home in Manhattan Beach dropped to $3.1 million. That is a 19.7% decline from the previous month. If you just read the headlines, you might think the market is crashing. It's not. This is a classic example of a sales composition shift. The median estimated value of all homes in the city, what the algorithms think the housing stock is worth, is sitting higher around $3.5 million. The fact that the sold price dropped to $3.1 million tells us the specific homes closing last month were skewed toward the entry-level luxury segment. Perhaps smaller lots in East Manhattan or original condition homes in the tree section rather than the big $20 million estates located by the Strand. However, there is a warning light here. The median days on market for single-family homes spiked to 50 days. That is a 177% increase from the month before. In plain English, homes are sitting longer. But again, context is everything. This spike to 50 days is likely a clearing event. It means that older inventory, homes that sat on the market through September and October because they were overpriced, finally sold in November. They cleared the deck. What that really means for you if you sell is that the market is punishing aspirational pricing. Buyers are there and they are willing to pay nearly 97.4% of the list price, but they are making you wait if you aren't priced accurately from day one. If you list at a realistic number, you move. If you list at a wish price, you are going to be part of that 50-day statistic. If you're buying a single family home, this is your moment of opportunity. That 50-day lag means there are sellers who are tired. They've been on the market for 2 months and they might be ready to negotiate. Look for the listings that have been sitting on the market. That is where your deal lives. I know these numbers can feel contradictory. Prices down, but bidding wars up. Inventory tight, but the days on market long. This is why you can't navigate this market with a estimate. If you want to sit down and map out exactly how these trends apply to your specific street and your specific timeline, you can book a one-on-one strategy session with me. There's a link below to schedule a call. We'll look at your real numbers, not the city averages. Now we have to talk about the money, the macro environment. Interest rates and the economy is the water that we are swimming in. For the first time in a long time, the water is getting calmer. As of early December 2025, the 30-year fixed mortgage rate has settled around 6.19%. We're down from the highs. The Federal Reserve has cut the federal funds rate again, now targeting a range of 3.75 to 4%. What this means is that we're moving from a restrictive economy to a stabilizing one. We did see a strange blip in the job data. ADP reported a loss of 32,000 private sector jobs recently, but most analysts see this as a shadow anomaly caused by temporary strikes and government shutdowns, not a systemic collapse. The unemployment rate is holding at 4.4%. For you as a homeowner in Manhattan Beach, this matters because we are approaching what I call the great unpause of 2026. For 2 years, homeowners have been locked in by low rates, refusing to sell. With rates stabilizing in the low sixes, that lock is breaking. Life happens. Kids grow up, people retire, families expand. We expect more inventory to slowly unlock in early 2026. If you're a seller, this means your window of extreme scarcity might be closing. Right now, you are one of the only games in town. By next spring, you might have more competition. But there is a bigger structural change coming to Manhattan Beach that has nothing to do with interest rates, and it's happening right on your commercial corridors. We're seeing the rise of the Residential Overlay District, or ROD. Because of state mandates to add nearly 800 new housing units, the city has had to allow high-density apartments along Sepulveda and Rosecrans. This isn't just a theory anymore. We have a project at 2301 North Sepulveda, the Oak Avenue project, that is proposing 7 stories and 40 units on a tiny lot. We have a massive proposal for the old Fry's Electronics site that could bring nearly 300 units. These projects are by right, meaning the city has very little power to stop them if they meet the criteria. In plain English, the physical character of the perimeter of Manhattan Beach is urbanizing. What that really means for you is that if you sell, that zoning is now a valuation metric. If you own a single family home in the tree section or East Manhattan that backs up to these corridors, your view and your privacy could change. Buyers are going to be asking about this. You need to know exactly what is being proposed behind your fence before you list. On the flip side, the city is fighting to protect the village feel of downtown through Project Pulse, buying up land to prevent over-commercialization. This creates a value moat around the sand section and downtown. Properties in those protected zones are becoming even more premium because they are insulated from the density happening out on the highway. So here's the central conflict for 2026: scarcity versus structural change. On one hand, we have incredibly low inventory and a buyer pool that is hungry for Manhattan Beach real estate. On the other hand, we have a changing skyline and a market that is ruthless about pricing. Doing nothing is still a decision. If you choose to hold through 2026, you are betting that rates will drop enough to spike demand, but not enough to flood the market with competition. You are also betting that the new development projects won't negatively impact your specific location. The bottom line is this: you can sell now into a market of scarcity where you're the prize, or you can wait for a market of higher flow but potentially higher competition. So how do you play your cards? If you're thinking about making a move in the next 6 to 12 months, you don't need a guess. You don't need to worry about whether you're pricing it right or if a 7-story building is going up next door. I help homeowners build a data-backed game plan that accounts for all of this: the rates, the zoning, the micro market trends. If you want clarity, you can request a Manhattan Beach equity snapshot using the link in the description, or just schedule a quick strategy call with me directly. No pressure to list, just a clear view of your options so that future you is glad you handled it this way. I'm Mr. Hernandez. Let's make sure you're on the right side of the market, and I'll see you in the next one.